Mortgage rates dipped below 7% again. So why doesn't it feel like a win? And despite a strong jobs report, is the economy actually cooling down? And how are the global bond markets messing with your mortgage? Well, hey, I'm Mike Petras with NPRE Boise, powered by NextHome Treasure Valley. And while I serve clients across the greater Boise, Idaho area, cities like Boise, Meridian, Eagle, Nampa, Caldwell, Kuna, Star, Middleton, and Emmett, this update covers the mortgage market on a national level with real implications for anyone buying, selling, or investing right now. So before we dig in, do me a favor, hit that like button, hit the subscribe button, and please feel free to share this with anyone trying to stay sharp on what's happening in today's economy and real estate. And of course, if you are looking to make a move right here to the Treasure Valley, nothing's better to let you in the know than my relocation guide. That can be found in the description below, or just scan the QR code right over here to my left. Well, here we go again, everybody. We're back below 7%, but just barely. Mortgage rates again came out swinging this week. And for once, it was in a good way. By Wednesday, we hit a low of 6.87% on the 30-year fixed, the best reading since mid-April, but don't get too comfortable. That improvement was very short-lived. By Friday, we're right back up to 6.97%, a level we've seen far too often this year. Still, the midweek rally gave borrowers a window. Jumbo rates moved between 6.98% and 7.02%. FHA ended up the week at 6.47%, and the 15-year fix climbed to 6.22%. Also, VA loans ticked up to 6.5%. So rates are still bouncing within a tight range. And the market is telling us it's not ready to commit to a direction yet. So what moved rates this week? Well, in a word, data, and plenty of it. The ISM manufacturing report kicked off the week with a whimper, weak enough to help bonds avoid any new sell-off. Then came the JOLTS report on Tuesday. More job openings than expected, but fewer people quitting. So a mixed bag, but overall bad for rates. But Wednesday was really the big mover. ADP payrolls were a shocker. Just 37,000 jobs added versus the expectation of 115,000. Pair that with weak ISM services data, and you have a bond rally strong enough to push mortgage rates down 0.1% in one day. But don't get too excited. Friday's non-farm payroll number came in 139,000 new jobs, and the market recoiled. Traders had already priced in weakness, and when they didn't get it, they bailed. They sent rates back to where they started. But given what I just said, there's still that growing concern that the tariff increases from the Trump administration could reignite and put this all out of whack, placing price pressures by late summer. And even though the PCE report was calm this month, CPI was too, inflation could still come back with a vengeance depending on what happens in Washington. So, what's the advice here? Do we lock or float? Well, if you caught that dip to 6.87% this week, congratulations. You timed it beautifully. But for most borrowers, we're back in the same tight range we've seen for weeks. And so if you're under contract, now is the time to watch rates daily. But if you're floating, beware of the volatility like usual. The average rate has moved nearly 0.25% in a single week. And that's enough to make or break your monthly payment. So my advice, lock if you like what you see. Don't wait for a unicorn. The market rewards action, not hesitation. Well, next week isn't quiet. In fact, far from it. We're staring down some of the most market-moving data of the month. It starts light on Monday with wholesale inventories, but by Wednesday morning, the Consumer Price Index. Arguably the single most important inflation report ahead of the next Fed meeting. CPI is forecasted just to rise 0.2%, with year-over-year inflation ticking up to 2.5%, and core CPI, which strips out food and energy, is expected at 0.3% monthly and 2.9% annually. These numbers are critical for rate movement. Thursday stacks on more fuel with initial jobless claims, PPI inflation, and core PPI all coming in early. If producers are passing on fewer costs, it could signal cooling inflation deeper in the pipeline. but any surprises here could jolt bond yields. Friday wraps with the preliminary University of Michigan Consumer Sentiment Report, a good gut check on how Americans are feeling about inflation and the economy heading into summer. But bottom line, rates could break out of their holding pattern next week, so be ready. So to recap, here's where we land. Rates dipped below 7%. Strong midweek gains were erased by a Friday's job report that wasn't weak enough to satisfy traders. So the bigger picture, the market is still nervous. Between tariffs, fiscal policy, inflation trends, and a slowing but not crashing of the economy, rates are being pulled in every which direction, blah, blah, blah. So if you're planning to buy, sell, or refinance, you really need someone who can help you read the market in real time. That's what these videos are here for, not someone that's stuck in the past. So if you're looking for a qualified lender, please feel free to reach out to me. I'm happy to refer you one right here in the Treasure Valley. And while I am not a loan officer, if you are looking for a realtor and you are looking to make a move right here to the greater Boise, Idaho area, better known as the Treasure Valley, I'm your guy. So please drop a comment below. Will rates go up or down next week? Well, if you like this content, please give me a like. Feel free to hit the subscribe button too and hit the notification bell so that you never miss out on one of these updates. And please feel free to share this with someone who needs clarity in this very noisy housing market. Well, I will see you next week. Same place, same unfiltered truth on what's happening with mortgage interest rates. Again, I'm Mike Petras with NPRE Boise. I look forward to the day that we speak. God bless. And I look forward to the day that I call you my neighbor.